Well, welcome to this Tampa live podcast. And just as a reminder, why are we here and what do we do? Why are we discussing markets? This is really a touch point of where we are. And what we discuss every week is going around the kind of the five fingers of the hand, as I would see it. We talk a little bit about inflation of the week, talk a bit about interest rates, equity markets, geopolitics, and other. And this is where the Bitcoin and other kind of aspects would come in. And just to give you a little bit of background on Moneta, because I haven't had a chance to describe a little bit. Moneta is an RIA based in St. Louis. We have offices across the Midwest, about 40 billion in assets under management, and we advise clients from 1 to 3 million all the way up to a billion. And we look at the context in which we invest. And this is really what this is the market backdrop. The idea being that this is the context against which all our investments are understood. And even though we're long-term investors, we think it's good. So I would love to have your input on what I'm saying here and really get a bit of a sense check, because I think we have definitely got a lot of news to handle. So the topics I'm going to cycle through briefly is this all going according to plan? Are the market developments, the movement of the dollar, the movement of stock markets, and the 10-year Treasury, which is where now it seems the Treasury Secretary would like us all to be focused, is that going according to plan? The week we've just had, DOGE has been in the headlines a lot. It's clearly dividing opinion, dividing commentators, dividing voters. And we'll talk a little bit about that and what it could potentially mean. The deficit is getting a bit more airtime than usual, which is being tied to the DOGE cuts. So is that a good thing? Or is there any link that we can possibly draw between DOGE and the deficit, and whether this is perhaps an illusory connection? We do have to talk about the Vance effect. We are international global investors. Clearly, the Vance speech in Europe went down somewhat strongly, we could say, and whether that has now had some unintended effects in terms of the impact on the European markets and on some European sectors. And then just this week, we've talked about NVIDIA and the invisible hand of NVIDIA, whether NVIDIA, as goes NVIDIA, so do the Mag 7, so do the other stocks, and we can talk a little bit about that. So plenty to digest this week, if we could only join all the dots. So this has been deemed as Trump 2.1 this week. We're out of the first month. We're now beyond some of the initial post-election euphoria. And what are we seeing in post-Trump 2.1? We're seeing some of the froth come out, certainly, of some of the equity markets. They're coming down. The Treasury yield is what we're all supposed to be focusing on. And that Treasury yield is also coming down, whether that's by design or whether that is in that we now are consolidating expectations around rate falls, or whether that's accidental. We don't yet know, but there's certainly a little bit of movement there. Bitcoin has lost a lot of the ground that it gained post-inauguration, and that's a bit of a mystery. The so-called developments in Bitcoin, and we have some slides later, would suggest that the reason it rose so much was because of the headwinds. And if we are not, in fact, the tailwinds of looser regulatory circumstance, if those tailwinds are still there, why should Bitcoin be reacting this way? But I think what we should be noticing is that Bitcoin is certainly moving in the same way as the stock market's suggesting it's very much a risk-on asset, and that's part of what we're trying to figure out with Bitcoin and other digital assets is what role do they play in a portfolio? And then when it comes to the dollar, we've had a stronger dollar for a lot of the time post the election. It's actually been a structurally strong dollar for some time, but that's now coming off a bit in this week. So we're moving into a little less enthusiasm overall in markets. And then the question is this what Trump wanted all along? We know he's focused on the Treasury yield, that he's been saying he wants rates to be a lot lower. Rates are now coming lower. Is that because the economic news is not as good as we thought? And because what we tend to happen is as the economy grows, we do see the expectations for rate cuts fall. So because the economic news has been a little bit less good, has that been really why the yields are down? It's not because it's all moving in favor of the Trump policy. Crude oil is down. Again, that would suggest lower inflation. That's certainly as you would expect. But is that down by design, or is that down because we again have had this poor economic news? So difficult to know why. And we know that the dollar is down. So it looks as if things will be working out according to plan. But I suggest that some of this weakness is actually the froth coming off the market. It's not. It's too early to say that some of these policies are working quite well. And then when it comes to DOGE, we have had a flooding of the zone in reality with DOGE. And I'm not sure what you're seeing in terms of your sentiment that you're observing. But I'll say that the we've got on the one hand the sense that DOGE is just an IT servicing or like a help desk for the very broken and out of date government computer systems, and then also the chance that this will then directly feed into alleviating some of the debt problem. That's the positive side. On the negative side, we think there is tremendous uncertainty around the layoffs, the instability, the general sense of what this could upend in terms of the economy. Fellow economist Torsten Slok has actually looked at some of the layoffs that DOGE is likely to give rise to, and in the immediate sense, it's about 300,000. It doesn't look like particularly meaningful in terms of the whole scheme of employment, but I think there is far more. First, that's federal employees. They say 2 contractors per federal employee. So that could clearly then be a ripple effect of federal employees being laid off. We know from the Washington, D.C. property market that that's led to a lot more property on the market. So clearly, very unclear as to this point where DOGE, what the impact of that could be. I think that the image right now, not only of the chainsaw, but also of a wrecking ball. Whether that USAID, what I've been hearing is that the USAID demolition essentially has been a testing ground, that was very small and significant amounts in the scheme of things, that if there is a desire to shave 2 trillion off the federal budget, that the cuts would have to be far more severe and far more sweeping. So I'd say that the purpose of this podcast is really to just set the backdrop, the stage for what we're facing today. And I'd say that is something that we hear from our clients over and over again. We were talking earlier about Tesla, and Ashley mentioned owning a Tesla, how that can sometimes be like having a target on your back at the moment. That we have a lot of clients concerned about holding, well, should they be holding the US equities they do in light of this uncertainty? And in particular, should they be holding certain stocks associated with certain officials? So it's very much on our clients' mind just what all this noise matters and means for their portfolio. In terms of the consumer, there's another sign this week equally that we're getting a little bit less frothy on the consumer sentiment. Consumer sentiment seems to be falling off a little. We've seen Walmart come into the crosshairs. The whole title of this podcast was In the Crosshairs because it seems like there's a new target every week. But Walmart saw some sales fall off. And I think we'd have to say if Walmart sales fall, there's probably a sign that the lower end consumer is really hurting. And equally that there isn't enough trading down or by the middle consumer into the lower end consumer. Is it losing share to Amazon? Maybe, but I'd say there's overall quite a bit of concern around the consumer not being that enthusiastic. And the consumer seems to equally be quite concerned about inflation. So again, it's the consumers, we have that 3% number that's sitting out there last week. It was a bit of a tantrum initially in markets responding to that. Now that 3% number was actually 2 weeks ago. If we parse it, it wasn't really 3%. It was 2 point something. It wasn't too bad. Markets rallied, but I think consumers are very much being affected by that, and that is behind the scenes. That combined with DOGE uncertainty, combined with tariff uncertainty, are conspiring to have a much less, I suppose, clear corporate outlook, and that's going to be an issue for equity markets as we go forward. And this is on the credit side. I'd love to maybe hear your view. This, I think, came from SNBC Nico, but it's very similar to what Torsten Slok has been saying, that delinquencies are a lot more, are starting to pick up in the credit card. Again, the lower end consumer. Most people pay back their credit cards that are not at the lower end. That's where we're seeing delinquencies. We're seeing it in mortgages a little and a little in auto loans. On the private credit side, since 2 of you are focused on that area, do you see any sign of delinquencies or just weakness, I suppose?
Nick, since he's more on the deal side.
Yeah, sure. Would you mind if we chat a little bit about DOGE?
Sure, I'd love to. At any time, I don't want to be, this is not a monologue, so I'd love to have DOGE first, and let's go.
So one sector that we were particularly excited about in the post-pandemic economy was government contracting.
Right.
In addition to healthcare services, IT services, and tech services. But certainly government contracting was one sector where we had been particularly active immediately post-pandemic. And what we're observing is that there is one of our assets specifically has a large ratio of revenue coming through USAID. And as a consequence, some of the work stoppage orders are creating cause for concern and revisiting the budget, relooking at covenants, those sort of matters. And so that's kind of a sideways situation. And then fundamentally, DOGE is a measure of austerity in a sense. And what does that imply more broadly about commercial clients and corporate borrowers more generally in the environment? And I think this is all aligned with what you're saying about markets starting to take a little bit of a risk-off posture in recent weeks in light of that. So those are a couple of observations that I would have about DOGE and DOGE's impact specifically on our portfolio. And that really brings us back to credit and delinquencies conversation. I think this is, again, another situation where asset selection among private credit managers is really going to expose who's been swimming naked, so to speak.
Yeah.
And so I think, our investment strategy has been particularly emphasizing critical service industries, defensive industries, for example, healthcare services or tech services, where we're hoping that the demand ends up proving more durable for those type of businesses relative to more discretionary businesses. For example, Walmart, it's tremendously worrying. I mean, it's quite worrying in some senses if the lower end consumers are not as enthusiastic as we'd hope there'd be. I think a lot of people over the last couple of years with interest rate increases were optimistic that 2025 was going to be their year. So much enthusiasm in the new administration about a more flexible regulatory environment. Is a more flexible regulatory environment going to lead to more M&A? Quite likely. What does M&A imply for financing markets and collateral values for private credit? Again, more optimism there. So I would just say my observations have been certainly aligned with a lot of the themes that you mentioned here.
That's great feedback. I'd love to just develop that a little, this idea of austerity, because I don't think we're really grasping what that actually means in terms of sentiment. Ashley, we spoke earlier about rebuilding here after the devastating effects of flooding. I would presume that affects the mentality of the consumer in Tampa.
Oh, absolutely. It is. I mean, it's changing the culture and the landscape completely of the beaches, and the housing market is definitely going to be affected. There's the supply chain issues starting to come into play. So from an economic standpoint around here, I can see it. And the people who can't afford to live, if you have outstanding debt and you have a house with a mortgage and now you've had to be out for 6 months in temporary housing, and how is the government going to help with all of that and ongoing with then all these other disasters that are going on? But it's definitely changing the culture and the landscape, I feel, and I'm curious to see how it changes it going forward. So as we talked about, there's people walking away from their houses and there's companies coming in and buying the land, knocking houses down and building up. What's that going to do with short-term rental status everywhere? And I know they're fighting that down on the beaches right now, but that changes the whole community.
Yeah, all of it is inflationary.
Yeah,
I think that's the point. This 3% level is a generic average inflation, none of which is actually experienced. You mentioned supply chain issues. This is before we even speak about tariffs.
right.
Which are clearly, whether you import your lumber from Canada or not, there's clearly going to be a disruption to the supply chain. And I think that is affecting the way companies can plan their decision tree. I think the preference is not to plan at all. And I do think you're right. The idea, this chainsaw, this cutting the fat, this combined with the AI wave, which is also designed to replace workers and create efficiencies. It does seem with DOGE, some of that may be even premature, the kind of the manner in which that's being done. But equally, we saw this week of a headline later about Microsoft cutting back on data center spend. So we seem to be building this expectation around AI spend, which seems to be extensive by certainly the big caps, the big large cap tech stocks. But will small cap, mid cap managers companies be able to even participate in that spend? We've seen the small cap sector quite, I think, a laggard in this respect. So I think that's a really interesting topic. Go ahead.
I was just at a portfolio company board meeting this past week for one of our staffing and direct placement companies, which provides some really interesting information about the labor markets and very tactical responses to economic news that way. And one of the themes that was discussed as a part of that meeting was this notion that they had 1 year ago, they had made a budget. They were going to spend $300,000 over a calendar year on artificial intelligence related investments to drive efficiencies. And in 2024, they ended up spending only $100,000. So that's 66% less than they budgeted. Rationale being that the return on investment, the payoff period for those type of projects was gonna be 18 to 24 months before they actually realized some of the efficiencies for that. So they throttled back their spend, and that's why they're also behind plan to some degree, or their explanation for being behind plan.
But I think it also, bringing back DeepSeek, remember, we're trying to join all these dots here, but the fact that that could come out of nowhere, essentially, for most market participants, even for some of the market players like NVIDIA, etc., that could essentially be as good in some ways, open source, cheaper. Wouldn't that make you also hold back on your expenditure? Because, well, why should I spend 300 when there could be a cheaper solution around the corner in it? I'm sure there's a term for that kind of expenditure in a year or 18 months. So I do think that's an interesting kind of again, sentiment psychology, when you think that will this be already redundant by the time I've finished my build?
That's totally a concern.
We definitely have a lot more.
There's two questions that I have that relate
That's
to
exact.
both AI, and then you mentioned something about housing. I saw a statistic today actually that said that new home inventories are at highs that we haven't seen since 2008. And then the second thing, which is a separate topic but also related, is from an artificial intelligence standpoint, it relates to your Microsoft backing off on data centers. How are we going to power the future of AI? I think that's the biggest concern today.
Yeah. It's also notable, and there's a chart a little bit later about how much large and small cap stocks have really trailed. There was a lot of narrative around small cap, that America first, onshoring, that America being more inward looking would be great for small cap, the mom and pop shops that don't export or not exposed to tariffs. It seems that this has not transpired. There has been, in terms of where the growth has come from in small cap and mid cap, most of it's come from earnings growth. It's been reasonably solid there, but there has been no PE expansion going on really in anything outside growth recently. So a very unloved sector. It's been very difficult for diversified core equity holdings to stand up against a backdrop where we have really growth outperforming so much. So I think this is whether we will see this change is the interesting part, whether small and mid cap will be overlooked repeatedly now, because it is about scale. It is about being able to spend on AI. You work at the lower end of the market. Well, what would you say?
Well, I actually think this discussion around active versus passive is a really interesting one. And I saw some posts that you put up recently, and it got me thinking about it. And one of the things I was thinking about is in the public markets, to me, having traded public corporate bonds for many years and managed publicly traded debt, I don't think there's really a reason to have active management in the majority of public securities. Stocks, no reason to, right? You should index for 3 basis points, and what you should be spending your time and attention on is finding the best private managers where active management really does matter. Because in the private markets, what we do, for instance, at ARI, we can shape the outcomes of the company we invest in, which is very different when I was trading the debt of Verizon and Comcast and $100 billion market cap companies. I'm seeing the results the same time everybody else is on Bloomberg, right? I don't really have any informational advantage. I have no speed advantage, right? Especially as a human now, you're gonna get your butt kicked by the machines every day, which is why I left bond trading, because I felt like I don't really have an edge in this, but I have a huge edge as an active manager investing in companies that I can help influence. I can help them shape their strategy. I can bring in new equity investors. I can structure the terms of the deal that are advantageous for them, but also de-risk it for us as the investor. And so my view is, and I don't know if this is a controversial view or people agree, I would basically say in publics it should be all passive, basically spending almost no money. You should allocate like 10 basis points per year on your AUM to manage your entire public's portfolio. And that's, by the way, that's not out of line with what you'd see at giant pensions or asset managers. Like when I worked at Summit, which is a $1 trillion manager, like they're allocating like 15 basis points a year to their publics, right? Which is probably high in this market. I would say allocate 10 basis points a year in costs to your publics, and then spend all your time, or 80-90% of your time,
Where you can shape the outcome.
have all your smartest people in the private markets digging in, being active managers, and not even just outsourcing, choosing, but bring it in-house if you can. If you have that
That's our
capabilities.
view, that the volatility is likely to
Yeah.
increase in equity markets. And again, you get, you, at least you may have the same volatility in privates, but it's certainly smoothed and not experiencing the same. I brought up this slide, which is close to the end, because we were talking about things in the crosshairs. You spoke about the ability to shape outcomes. It used to be thought at one point that Vanguard, BlackRock, the large players, through their engagement, could shape outcomes, and that was particularly the case. You know, TIA, I'm sure there would have been lots of focus on the ESG policies, etc. Clearly, this week it's getting. I would say that the headwinds just continue to grow for ESG strategies. The latest being activism now, or not even activism, engagement. Activism was always something subject to SEC filings, but now basically with SEC guidance suggesting that even BlackRock and Vanguard, acting as they do in engaging with companies, are need to file that's their attempts, that they're trying to shape a company's outcome. They would need to file onerous filings. So again, they will continue to backtrack from engagement now. And we've already had the ECB kind of suggest, the ECB is suggesting central banks should back out of climate politics. That pretty much then goes for the US Fed and everybody else again. And then it watering down of climate accounting policy in Europe. So I would say this headwind was definitely in our Trump trade. And this is playing out exactly as we would have thought. I'm not sure whether it would be, I'm interested, given we're based here in Florida, sorry. Should have been turned off. Given we're here in Florida, is there any sense of, we've had pension plans here not being allowed to hold certain holdings, and a bit of a, Florida and Texas are often bracketed in the same bracket in terms of their ability to invest certain, any on the ground sentiment around that?
Well, this is cyclical,
Right.
like everything is in investing, right? So it's going one direction now. The pendulum swung very far in the other direction 2 or 3 years ago. Now it's swinging back. It always overshoots. So that's how I plan for it. And really, it's the type of thing where people just need to vote with their wallets, right? Like, I don't really care what someone's politics are. If you like what I'm doing and you're aligned with it, show me the money and I'll show you a lot more money.
Yeah.
Right? If you don't, go somewhere else. And if you don't like what BlackRock or Vanguard are doing, then don't put your money with them. It's that simple.
Yeah.
Like, we can whine about it all day long, like money talks.
How about on the Star Mountain side? Any sense of this affecting what you do, or any pushback?
No,
The private sector's been always somewhat insulated from.
I agree with the same sentiment that you have about the markets. The pendulum always swings back and forth, and it always shoots every single time.
Yeah.
Right. So I think if you just focus on the basics, I mean, that's the nice thing about the private markets is you're not influenced by the volatility and the swings of the public sector, and you have the ability to control your outcomes. I think that's the key, right? And that's the benefit of the private markets.
Well, speaking of pendulum swinging, there are 2 more small items I'd like to cover in the last 5 minutes. One is Bitcoin. We've already discussed that a little bit today. That was part of the rout that we've seen in the last week. It didn't help that we just read about State of Wisconsin Investment Board buying more Bitcoin. I don't know when it bought the Bitcoin, but it now seems to have over 300 million in there. One of the first, I think, public pension plans to be so open and so high conviction about that holding. And then, various other kind of cracks, I suppose, in terms of crypto exchange Bybit seeing something being stolen. The total route now seems to be 800 billion being wiped from the crypto market. But at the same time, we've got a lot of positive and negatives here around Bitcoin. We've got certainly the regulatory tailwinds, you would think, in terms of owning it, but equally maybe went too far too fast. It's we as in an RIA tend to provide a lot of education around Bitcoin and digital assets as opposed to actually providing advice on holding it. But we do see it being held increasingly. But I think this is another reminder that the volatility is not for the faint-hearted. The last topic is just is Europe in the crosshairs. This is something, and this is again getting to the unintended consequences, which is why we have such an interesting time today, I think, because just as Putin's invasion of Ukraine led to NATO galvanizing, I think now, I said a lot of time in Europe, it seems that this anti-European rhetoric, the Vance speech, the kind of the Europe is an afterthought for the world, these type of headlines, the transatlantic alliance being dead, this seems to have led to a bit of defiance in Europe, a bit more surprising collaboration. And we spoke earlier about defense stocks and that being a thesis around government spending. Ironically, it's actually been the European defense stocks. I don't think I have the chart here. It is here. The European defense stocks that have done a lot better, the stocks that chart on the right here have done a lot better in recent weeks than the US defense stocks. The US defense stocks were always fairly buoyant, good, whether you call them defensive stocks in the traditional sense. But we now are suggesting there will be defense cuts here. And we know in Europe there have to be defense, more investment in defense.
I think American defense stocks are a good short. I do a pair trade long European, short American. Why? Because we don't need to spend as much as we do if we're only defending our country. The reason we need that military is to basically control, outcomes across the globe. If we're going to be isolationist, we need about 1/10 to spend, and that's the analysis that we've done shows that about roughly could cut 80-90% of the budget if you just want to defend America.
That's interesting.
Good luck trying to attack America crossing the Pacific or the Atlantic, right? It's not going to happen.
That's interesting because that seems to, I wonder how that would fly with the base politically. Because like Pete has said, and I think the America First and the strong man policy, whether defense spending is part and parcel of that, is that the one stronghold that will not be cut? I mean, we know it will be cut probably. Any thoughts on?
I do not have a perspective
Yeah.
on that. I just, as an American, and why do I have so much conviction in our currency and patriotism for our mission of investing in the growth engine of America? For me, a large part of that is predicated on the historical strength and dominance, if you will, of the U.S. military complex.
So at least ensuring that that is on a par with what Russia is doing, what China is doing, I think more important. I think if you look at the comparison between China's investment in ships, I think we've built single digit number of ships been built here, and China must have built 1,000 in the same time frame. So that might be the factor that perhaps is the arms race, quite literally, in terms of the defense. But it is this has been, I think, part of the unintended, and even in Canada, where we saw now the Liberal Party looking quite competitive under, of all people, Mark Carney, who we used to listen to a lot in the Bank of England, now kind of riding pretty much like a leader in the Liberal race there to lead the Liberal Party, and the Liberal Party really consolidating, didn't just take a hockey game, but that was certainly part of it, the US-Canada hockey game. These are the unintended consequences, perhaps, of this strong tariff rhetoric. I showed a headline which was just around the Trump. This is just yesterday's headline. That Europe is the latest to get the 25% threat. And there is a sense that this is all part of the plan. First it's a threat, then it's rolling back at the threat, then it's incremental reciprocal. And that seems to be something markets are now even starting to run with in terms of the development. But we are, this is perhaps, I think you mentioned doing the pair trade. This does suggest that we've also in the latest week had more certainty around Germany. We talked about the pendulum swinging. Something we are seeing in Europe, though, is that the pendulum, it may swing pre-election in terms of sentiment and right wing, but it tends to settle sort of somewhat uncomfortably in the middle for some. There was too much gain, perhaps, by the right wing parties. But even, I would suggest the other last, and I'll end on this, unintended effect of the Vance speech is perhaps that Europe now knows its limits in terms of how far it's prepared to go. We saw a French right wing politician pull out of CPAC after gestures were made by Steve Bannon. So maybe that is a red line has been now drawn, and that may be something that we know at least where everything lies. So I will leave it there, I think, for today in terms of recorded remarks. Feel free to chime in on anything else, and take a cookie, please, for your children or for your spouse or your mother, and take because and those of you who've driven a while, and a drink. And really, I think this was a great discussion. I love getting people together with no agenda on my part, but just to debate some of the things and what you're seeing both on the ground, around whether from a consumer standpoint, rebuilding literally, or at the portfolio company. It's really fascinating.